CF benchmarks.
What you're about to hear is a recording of a CF Benchmarks X Space captured live.
This is the latest CF Benchmarks X Space. I'm Ken O'Deleger, Head of Content. We have a panel of regulars. That is Gabe Selby, who's Head of Research, Mark Pilipczuk in the research team as well, a research analyst. We also have Mr. Thomas Perfumo, who is Kraken's Chief Economist. Our guest today is, and we're really pleased that this is the case, Wang, who is a Senior Product Manager for CF Benchmarks. Jin is going to talk to us about the CME launching a Bitcoin Volatility Index future contract. So we'll get to that later in the show. To kick things off, we generally start with macro or news, and there's been a few major macro pointers over the last few days, chiefly inflation data on the data front. And we've had both CPI and PPI. The CPI, starting with CPI first, massive spike, 3.8% year-on-year rise, 0.6% month-on-month, and the core was also up 2.7%. You don't necessarily want to see that core month-on-month up 0.4% as well. Hey, Thomas, would you talk us through this and what we should be worried about, maybe what we shouldn't be worried about, maybe?
Yeah, straightforwardly, this year has been a big reversal in terms of expectations of interest rate decreases, not just in the US, but also other regions like Australia, UK, Canada, etc. And over the last several months, because of the pickup in inflation, not just in part because of uncertainty around tariff policy and how that weeds through the supply chain, but also more recently with the conflict with Iran and energy prices shooting up, there's been a significant amount of pressure on consumer prices in the economy that is resetting expectations from, maybe 1 or 2 interest rate cuts here or there to no interest rate cuts for the foreseeable future and the possibility of a rate hike to deal with this increase in inflationary pressure. And so just to be pointed about it, as of like even a couple of weeks ago, the futures markets were pricing something along the lines of like 80% chance that we see no change in interest rates and maybe a 15-20% chance that we see one interest rate decrease by year end 2026, and let's call it 2 to 5% chance we see an interest rate hike. That's flipped in the last few days since this inflation print, where the futures are now pricing in a 32% chance as of this morning that we see an interest rate hike by year end 2026. So yes, the hot inflation print was definitely a net negative on this front.
Yeah, your views on this? I know you got plenty.
Yeah, so I think last week we talked a little bit about how that there's this expression of how one data point is one data point. Well, we're starting to just see, I think, a more of a persistent trend in hotter inflation prints. PPI yesterday was a 1.4% month-over-month increase. I think that was 3 times the consensus, and it's the sharpest monthly increase since March of 2022. So as Tomas was saying, I think the Fed is definitely starting to kind of, I think, being forced to really only move in one direction when you have inflation running above target and when you have unemployment and you have kind of the labor market starting to strengthen. So you really are starting to see, I think, more of like this hawkish momentum begin to permeate through the FOMC. And it's actually just like what Tomas was kind of alluding to there was the broadening effect. Gasoline CPI this week was up 28% year over year, and it's starting to show up in these pass-throughs. So you look at like domestic passenger airfare, that was plus 3% month over month and plus 15% year over year. So airfares are really kind of starting to see this bleed through. That's also going to, some of these material things like apparel. And you also have I would say Strait of Hormuz related inflation starting to rebound with lodging away from home. So it's really starting to become, I think, more of a persistent problem, which puts the Fed, I think, really in a tough position going forward. And so, I think if if you look at the probabilities, like what Tomas was saying, with a 30% probability of a interest rate hike now in 2026, that is now becoming a bit of like the base case, or more of a base case. Whereas last week that was a complete kind of like tail risk event.
Yeah. So kind of almost alarm bells being rung on this now. Hey, Mark, are you noticing anything in terms of market impact? It's kind of early days, but generally these things kind of subtly seep their way through. Anything at all from your point of view?
Well, when it comes to market impact, a lot of this is kind of relatively priced in. I mean, you can see the oil prices will lead the CPI inflation report, so you can see in real time where that's going to go, and you can kind of figure that that's going to pass through all over the place. Diesel prices rise, shipping costs rise. You'll see food at home was a category that was up 5%, year over year. So the market kind of seems like it was relatively prepared for this. I mean, if you're looking at the S&P and the Nasdaq making all-time highs today, it doesn't seem like it's too.
Yeah.
It's not too bothered by it.
Yeah. But somewhere down the line,
the market's a good point though, because if you look at the 10-year, I think it made a new year-to-date high, and last time I checked, it was hovering around like 4.5%. So you're seeing the bond market do a lot of, I think, heavy lifting. And if we weren't seeing such a strong, robust rally, I think, in the equity markets, which we can kind of talk a little bit about how that's being kind of distributed, you would actually start to see kind of like, I think, a lot of financial conditions pressure. But I think the equity market rally has actually been kind of, I don't know if it's fair to say, but it's kind of masking the tightening in financial conditions from the rising interest rates that are kind of being re-rated from this consistent inflation.
Yeah, that's it's a good point. Kind of adjacent. Let's talk about also some policy stuff as well. Tomas, we now have a confirmed date for a markup of the Clarity Act. I'm not sort of like a civics expert, so just walk us through exactly what happened, how we got here, and also what it might mean from your point of view.
Yeah, so Clarity Act's been a whipsaw year to date. Just to give you a sense, we began the year with prediction markets calling for a 75% chance we'd have the Clarity Act legislated and introduced as law within 2026. That fell all the way down to the high 30s, low 40s. We're now back to 70% territory. So it's been a pretty big whipsaw in terms of expectations, all around this debate around stablecoin yields and whether the Republicans are going to maintain control of the Congress in November in this election year. But where we stand right now is in a pretty good spot, because over the last several weeks, there's been a lot of negotiated compromise between different lobby groups. Procedurally, today's an important day because today is the scheduled release of the markup, which is basically the draft bill text that's coming out of the Senate Banking Committee. And so they're actually live right now voting on the Banking Committee itself is voting on amendments. And the expectation is that either today or tomorrow, depending on how quickly they can vote through all the amendments, which there are over 100, they're going to basically push the draft bill out of the committee itself. And then from there, procedurally, they need to go through a reconciliation exercise with the other Agriculture Committee and the House versions, with the expectation that we might get to a floor vote on this bill, like a final bill effectively, within the next several weeks, sometime likely in June. And so today is a big procedural step because this bill has been basically locked in this committee for going on over 4 or 5 months now. And so having it get to the precipice of becoming introduced into law is like a really big deal. So my expectation is if you see Democrats voting in favor at the committee level, I think that we're in a really favorable spot, but it's not a necessary requirement.
Yeah, just real quick on this, on that, Thomas. I presume you've had a glance at the wording of this markup. I mean, we could go in all sorts of directions about whether it's been worth it, the wait. But what's your general view on it? I mean, does it seem like a credible, win-win, as it were, inverted commas, speech marks? That that will provide it with good chance of being confirmed.
It seems to be the case. I mean, the Republicans still have a favorable position in the Congress. Crypto is generally a popular issue, and I think there is genuine bipartisan support for this bill. I think a lot of the party line voting, the partisan voting, if you want to call it that, has been more a consequence of disagreements or negotiating tactics around several components about it, whether it's to do with law enforcement or to do with ethics provisions and stuff of that nature. But in general, I think the bill's in a good spot. And when you think about the fundamentals, like why is it relevant? I use this like simple analog, which is last year you had the Genius Act, the stablecoin bill, and within months of the legislation, every bank, payment processor, financial institution is now talking about how to integrate stablecoins into their platform across the different use cases because they understand now what the implications are for doing so. They can work with certainty with the regulators around how this is going to impact their business. And the Genius Act has a very similar, let's call it like repercussion, I think, for market infrastructure providers, whether it's an exchange service or a broker service, a bank, et cetera, where they're now going to understand the taxonomy of these assets, who is the regulator for each asset, what are the implications for their business and how they bring it to their end customers. And so I think that certainty is going to be a really big, important milestone for crypto in general. All of this deregulatory attitude and shift over the last year and a half has been super positive, but businesses cannot guarantee with certainty that it's going to stick unless it's a law.
Mm. Anyone else have any perspective on this? Please go for it.
Yeah, I've been following this one pretty closely too, and taking a look at this morning, it seems that the idea that this is unlikely to pass is kind of gone. It looks like there is real momentum there when you get to a markup. What's kind of left now in terms of risks is that an ethics provision of some sort becomes a mandatory thing to get broad Democrat support or to get enough Democrat support to get it over the line. What an ethics provision looks like is still kind of unknown. It's still up in the air. It may or may not happen. Another kind of key risk to watch out for is the timing risk or the actual calendar risk. So we are getting pretty far into the midterm cycle, and what tends to happen is a focus tends to shift towards later in the year. They'll focus towards appropriations or budget, and then they'll focus on campaigning. So this can fall off the calendar. So what we almost need to see is we need to see by the end of the month for us to get this onto the floor to start the voting process. Otherwise, it becomes a very uphill battle when it comes, because then you start running into summer recesses, appropriations, and campaigning and stuff.
Yeah, excellent stuff, actually. And I want Gabe, let's pivot now. We're still kind of in Washington, but let's pivot to another incremental move because Kevin Warsh, the Fed nominee, the White House's Fed nominee, was confirmed, I think, by the same committee, if I'm not mistaken. Gabe, I guess you've been looking at this, the details. It looked like it was a pretty narrow vote. I think I read, if I'm not mistaken, 54-45. That's, not it's emphatic, but it's quite, it's quite firm. What's your view on the color surrounding this, actually?
So I don't know if the fact that he was ultimately confirmed, whether it was by an overwhelming majority or more of like a split consensus, which is kind of what we got, is structurally too important. I'm still focused on Powell's decision to remain on the board. He has up until I think 2028 until his actual chair would, or as a term as a board governor would expire, so he could be on there for some time. And he's the first outgoing chair since Eccles in 1948 to stay. I'm looking at kind of what I'm going to try and follow what he's ultimately going to try and do because, he kind of left us with a bit of a unknown as far as the more of like a subjective measure of what he defines as, making sure that the institution of the Fed's credibility and its independence, remains intact, and he wants to do his part to kind of defend that. So I think, regardless, I think Kevin Warsh, he's going to be the next Fed chair, and it's going to be kind of an uphill battle for him to appease the person who appointed him. I think that we've talked a lot about his viewpoints of how he wants to maybe adjust the framework for the Federal Reserve and how they do their kind of like their monetary step functions. I think that it's going to be a really, really tough job to kind of appease President Trump and the clear easing bias that he wants to have through the institution, and get the consensus, voting members to follow along with the current economic backdrop. So it's going to be, I think, a challenging introduction to his chairmanship. And I think we're going to see. I think that's going to be kind of like a bit of like a interesting thing to see of how this new regime, the Warsh regime, handles what inevitably is going to be a lot of pressure to lower interest rates in the next meetings. And I don't think he's going to have too much success in doing this. So particularly with Mr. Powell staying on the board.
Yeah, I mean, I think, Gabe, in a nutshell, that's it, right? I mean, whenever I think about this situation, the word credibility comes to my mind. Not his credibility. I mean, I think he's obviously a solid pick, qualified, aware and intelligent guy, for all we know, as far as we can tell, with integrity as well, which is important. But of course, you can't serve two masters. I mean, he has signaled the word allegiance is maybe too strong, but he has signaled his allegiance to the president and the president's view, which is, of course, to cut rates, essentially. But he's also tried to signal to the markets and to the economic community, if you want to put it that way, that he's going to remain data dependent. He's going to be a credible Federal Reserve chairman, steward, if you like. You can't serve two masters. Thomas, I just wonder, from your point of view, the way that this has been finessed. So he's now essentially Fed chair elect, if you want to put it that way. Not necessarily that emphatically looking at the vote, but maybe, as Gabe suggested, that's not important. But are we seeing any sort of suggestion that the wheels are already coming off, or from maybe your point of view, are you getting more convinced, or what's your view now? Has it changed, or is the situation improving, or really he's still got as challenging a situation to face as you always thought he would?
It's challenging. It definitely got more challenging for Gabe's comments around Powell deciding to stay. As much as Powell wants to say that he's not going to be like a shadow chair, maybe that just means that he's not going to like exercise like any kind of quasi leadership authorities or influence. The fact that he's there doesn't matter. It's not a secret. I think the biggest, let's call it like problem or concern, there's just been like this over politicization of the Fed in general. I'm gonna be maybe perhaps controversial with this. Like, I believe this whole like concept of like the Fed is independent, or Kevin Warsh is independent, is kind of a red herring. Like, at the end of the day, the president gets to choose and nominate members of the board governor, and of course, there's nothing that suggests that the president has to choose someone that he or she disagrees with. That's nonsensical. And my view personally is that President Trump found someone who independently like believes themselves fundamentally that interest rates should be lower. And so I actually do believe that Kevin Warsh is like his own independent, human, his own independent thoughts and minds, and he believes that we have an environment where, if you look forward and look past like the volatility and the conflict that exists today, that you can make a case for lower interest rates and that it makes sense. And so I think that a lot of people are like in the moment, like really stretching their mind of like, oh, this is a puppet or something. I really don't think that's the case. I do believe, however, again, because Powell's on the board, it gives Trump one less nominee to put on the board as a voting member. And the board, per the vote that took place in April, mind you, under Powell's leadership, was the most divided vote since 1992. And
Yeah,
so I really think that the real story here is less about Trump, and it's more about the fact that the current board is a bit divided on directionally on what they view as a consensus good idea. And this decision by Powell to stay on the board doesn't cure anything.
absolutely. Yeah. Your point is really cogent, actually, Thomas. That Warsh is an independent agent, an independent thinker, and maybe the argument that I've put forward, or that side of it, is not taking into account the fact that maybe Powell is wrong, or maybe Powell is marginally wrong enough, perhaps, to warrant a more serious discussion about a lower rate path. Let's try and move on though, because and I want to stick with you for now, Thomas. Mark earlier mentioned that the market looks remarkably sanguine, considering, as we've mentioned, we've had some potentially alarming economic news in the last few days. And notwithstanding all these other sort of like this other color that we've mentioned as well, the market is doing quite well. Bitcoin is currently, looking at Bitcoin futures, $81,000, holding that around that 80 handle that it retook a week or maybe 2 weeks ago. And Thomas, you've also got some interest, I believe, looking at your recent research report by you in the 200-week moving average and its role as a support. The last time it was actually there, of course, was in February. Structurally, these 200-period moving averages, both on the daily cadence and weekly cadence, are generally seen by the market as important. Why, in your view, is it in the spotlight, or are you highlighting it now?
I guess I'm not let's start with that. I'm not a chart technician or like a super expert on charting in general. It was an indicator that I came across that I thought was interesting, and it actually blends nicely with two other things that I focus on. One would be in terms of like the 4-year cycle, 4-year patterns. One thing that I noticed from this past cycle is usually Bitcoin doesn't fall below the price that it trades in within 30 days of a halving. And so if you look at the last halving, which was April of 2024, the price within 30 days then was around 55, high 50s, around there. And we haven't traded below that. It happens to coincide with a 200-week moving average. And likewise, when I look, this is where I care more from a fundamental perspective. When I look at where and when Bitcoin ETFs like really flipped from net sellers to net buyers, it was really in that kind of mid 60s range. In fact, from the data that I have, anytime Bitcoin traded below 65K on a day that equity markets were open, the Bitcoin ETFs were buyers, net buyers, 100% of those trading sessions this year to date. From my perspective, the 200-week moving average is interesting in that historically it's been very well supported, with the exception of one period of time around mid 2020 to early 2023, which was really governed by massive failures in centralized counterparties like Celsius, Digital, Voyager, BlockFi, Three Arrows, Terra Luna, FTX, Silvergate Signature, etc. And so I like to think of this kind of market environment where you don't have that kind of like systemic risk, where I see this indicator that has held up well, and where I see Bitcoin flows also holding up well through ETFs. And that's why I have a lot of like conviction that you have a tremendous amount of bid support in the 60s when I frame a risk reward conversation.
Absolutely. And this is brilliantly merging the observation of flows with the observation of price, of course, which we like to do. And I want to get anyone else in on this, because clearly we seem to have moved into a more comfortable regime. Maybe even if I just limit myself to flows, We've had, I think, consecutive weekly flows up to this week, but not necessarily this week. I'm looking at some data that suggests that we've had a bit of an outflow in the last few days, but we've had consecutive weekly flows for at least 3 weeks, if my data is correct. Gabe, what is your view on this? And structurally, would you even go so far as to say that we have now seen a regime change back into a more constructive regime?
So I think it's extremely constructive that we've seen that bid support in that 60 range. It's something that is pretty indicative. If you look at the charts on even like a daily time frame, you see the wicks of these dips downs, and then you see candle closes above. And it's unfortunately though been kind of a bit of a slower grind up higher into the 80s than what you'd like to see. You compare that to kind of the V-shaped recovery that you saw in equity markets. That's a little bit more of like a higher volume, higher conviction type re-rating that you typically see in the charts. Whereas this is a bit more of like, okay, we're taking the stairs up, but is the elevator going to be waiting for us at the top to go back down? So I think you look from a capital allocator standpoint, you've got these types of signals year to date performance wise. You've got Bitcoin still down about 10%, ETH is down 22%, the S&P 500's up around 8%, Nasdaq's up even more. These large cap cryptos are laggards right now, and if you're trying to find areas of maybe discount or relative value, from a pure range perspective, you can still find that with Bitcoin and ETH. I think it's getting harder and harder to justify some of these valuations that you're seeing in the tech space with the current rally that we've seen in this earnings cycle, which has been kind of extraordinary. So I think that's a key component. I think one thing that's going to kind of continue to kind of hurt Bitcoin is its particular sensitivity to kind of a duration asset framework. So we've seen how these inflation prints have dominated our headlines. They've been kind of the center point that we've started this call out with. But if you looked at the GDPNow, which is kind of like a higher frequency read on the coming quarter's GDP print, it's quietly been decelerating, and you've had this against the backdrop of rising inflation. So I think the Atlanta Fed Now forecast, or the Atlanta Fed Nowcast for Q2, has come down from 3.7% earlier in the quarter to around 1.7%. So what happens when you have higher inflation or rising inflation and slower growth? That's kind of like that empirical stagflation tilt that you are seeing right now in these nowcasts. And so I think for Bitcoin, that remains kind of a major hurdle in trying to get over that duration asset framework.
Yeah, and let's broaden it out a little bit to the altcoin sector, if you like, because Thomas, I think you also mentioned in your recent deck that there's been a bit of a relief rally, potentially led, or maybe I should say structurally led, certainly not to the beta by Ether. Now, is what we're seeing what we think we're seeing, or is it basically, is this some sort of artifact that is not really signifying what it tends to signify? It looks like a sort of relief rally, a rebound. It could be a mean reversion. But I want to frame it correctly. So tell us what your view is, please.
Yeah, I mean, honestly, this year to date, my view has been that Bitcoin as the macro bellwether asset for crypto has been like the leading asset for the broader industry. Like it's very rare to see a day where another altcoin, call it ETH, Solana, etc., is doing well on a day that Bitcoin is doing poorly. And so Bitcoin is kind of like the leader in this market environment. And what I think I've seen year to date is that for the first, call it month of the year, all the assets were tracking generally in line with each other. Then they started decoupling as we had the drawdown event in early February, and Bitcoin is leading pretty much most other crypto assets by Ether by 10 percentage points, for example. And then up until recently, it was leading Solana by upwards of like 20 percentage points. And so in the last couple of weeks, what I noted was that for the assets that were meaningfully dislocated from like Ether, which is kind of running in the middle there between Bitcoin performance and Solana, we've seen some assets, including Solana, do a bit of a catch-up trade to get back to like where Ether is trading at, which is still a pretty meaningful discount to Bitcoin year to date. But beyond that, when I look at like that same indicator, 200-week moving average for Ether or for Solana, for example, like they've been trading well below that moving average, and they just can't break through the test. So like Ether, for example, 200-week moving average is 2450. It just hasn't been able to break through in the last several weeks, even though it came close to testing it. I just think that the fundamentals there aren't accelerating fast enough. Things like stablecoin growth or tokenized equities, very positive, but just not at a pace where those assets can just break through and decouple away from Bitcoin and really outperform. It's still possible, but it just hasn't happened yet. And in the meantime, you're just, waiting to see what happens with Bitcoin, whether it breaks through ranges and stuff like that before it leads into some performance for Ether, Solana, etc.
Yeah. So Mark, to get you in on this, to me, just in my simplistic way, it kind of sounds like, the faults of Ether's virtues coming in once again. The sort of like backdrop, the technological backdrop, not moving fast enough to actually benefit the original configurable coin. But what protocols are being sort of like uplifted by this resurgence, if you like, of sentiment, if nothing else? From on your radar, what are you seeing?
Yeah, when we look at the breakdown of the market through the DAX, our classification structure, where you're really seeing it is in those services tokens. So you're seeing specifically it's within these computing and AI related names. So things like BitTensor are really outperforming, or there's been other platforms where you have access to LLM tokens like Venice AI, or platforms like Akash even, where they sell compute. Anything related to compute or AI has been catching a bit of a residual bid from the equity markets. So wherever you're seeing people take risk in the equity markets, you're seeing them move further out the risk curve and kind of try to target the same things within crypto. Where you haven't seen as big of a rebound are things that still have a regulatory overhang, like within DeFi. I wouldn't really expect much until you get market structure clarity and you start to see, you need to see some larger players actually build real things on top of those rails before you see any kind of structural bid there.
Yeah, absolutely. Yeah, Gabe, any views on this? I'm kind of thinking, whenever we get these sort of situations, there used to be, I'm going to show my age, be talk of the so-called Ether killer. What are the alternatives to Ether? How are they faring? Are they showing that they're any more robust or any more favored in this kind of environment?
What we typically look for in a structural bull market shift is for altcoin kind of to be like altcoins to be more leaders. And in this case, as Tomas has been highlighting, that just hasn't been the case. And it's just been kind of a non-convincing steady climb up from those February lows for digital assets. And so I'm really hoping to see, and if you look at like the 200-day moving average for Bitcoin, it's bumping up against that, but it hasn't quite crossed back over. This is the moving average that we crossed back in October of last year, and haven't really been trading above it ever since. So it's been kind of like this structural downtrend for that. When we look at the cross asset, picture, we're seeing how the correlation for Bitcoin and these cryptos has kind of fallen when you compare it to equities. And I think that kind of is a little bit of a misleading signal, because if you look at the equity composition and distribution of performance, it's like what Mark was saying, it's really centered around the AI theme. So the AI names, which have the highest market cap influence on the equity side, have really been driving performance higher for these beats and for the earning surprises, and that's not really kind of I'd say permeating through to broader equity market strength yet. So it's really not so much of like, okay, Bitcoin's decorrelating with the Nasdaq. It's like Bitcoin's decorrelating with the very few AI names that are really just driving the Nasdaq higher. If you want to get more technically specific and break that down.
Yeah, absolutely. We've kind of touched a little bit on market structure in this conversation, maybe not as much as we do sometimes, but we're going to pivot quite markedly to market structure now because some major news, certainly for CF benchmarks on the product front, is the fact that the CME group, the largest derivatives marketplace in the world, certainly the leading derivatives marketplace in the world, has announced that it's going to launch a Bitcoin volatility future contract or futures contracts from June 1st, pending regulatory approval, which is the sort of words they always add to everything when they're launching new products. But it's most likely to happen from that date. Now, as with all CME crypto-related contracts, these are all settled to CF benchmark's indices, settlement rates. And, the CME, the proposed CME volatility futures will be no exception. The underlying index for this contract will be our CME CF Bitcoin Volatility Index settlement. It also comes with a spot quoted, a sort of streaming version, which is prints every second. But the settlement index will be BVXS. That's the ticker. Now, we are lucky enough to have with us today the senior product manager in charge of BVX, who my understanding is that, essentially BVX has got a lot to do with Zin. So basically, Jin, I want you to basically talk us through the BVXS and this launch. Now, my awareness is that, of course, the BVXS, the actual settlement rate, was, basically launched by CF Benchmarks well before, of course, the futures contracts were planned. Now, I think it's a good idea to give us the structure of how this BVXS works. So, Jean, if you don't mind doing that, that'll be great.
Yeah, of course, I guess. I mean, it's really a significant news for us because right now, after this futures launch, Bitcoin Vol is becoming something that's, directly tradable listed futures exposure. So like before, if you wanted the Vol exposure, you generally have to trade a strip of options, OTC structures, or use some imperfect proxies. So the BVX futures launch actually creates a very clean listed instrument for isolating the vol risk from the price direction. And in terms of the index that the futures settle to, we have two variants. The first is BVX, which is the real-time variant of the index. Itself is a 30-day forward-looking implied vol measure that's based purely on CME Bitcoin options that includes the regular size and the micro size contracts. And BVXS, which the future settle to, is the settlement rate version of BVX, and itself is calculated through a TWAP structure of the real-time index itself. So let's say today when we say, BVXS is around 39 to 40, what we are saying is that the CME options market is pricing roughly a high 30s, low 40s annualized 30-day implied vol environment. And at today's level, you could roughly translate that into a 11% standard deviation move over 30 days, or let's say if the Bitcoin price is at around 80K, that would be around $9,000. And when we are talking about this launch, I think what's the key point here is the market structure, as Ken mentioned. So Bitcoin already has the spot reference rates. It has the listed futures, options, ETF, and also a growing basis market. But right now, what a listed volatility future adds is the next layer is the ability to transfer the Bitcoin vol risk directly into the regulated format. And we are really excited to be the benchmark powering this move.
Absolutely. So let's think about this actually a bit more, Jin. So would you say, or to what extent would you say BVXS will be analogous to the VIX, if you like? It's a 30-day forward, it's a measure of 30-day forward volatility. But I mean, even as I ask that question, I know that it's it's a little bit more nuanced the Bitcoin in the in the Bitcoin market structure and Bitcoin trading. How is it similar and how is it different?
So, sorry, I missed the question.
I beg your pardon. I'm just trying to basically understand the extent to which BVXS can be thought of as analogous to the VIX volatility index. How useful is it to frame it in that way? And if it's, the ways that it's not necessarily similar to that, how should potential practitioners and users of the BVXS and also the forthcoming BVX futures, how should they think about, what they can actually get or how they can actually deploy these new tools?
Yeah, I mean the idea, the ideology, the methodology, the calculation is very math-based, and it follows the same variance swap replication as the equities VIX index. I mean, you could see that the VIX is an analogy, but I would be really careful with that on there, because what we are looking here is the index is based on CME Bitcoin options market. I mean, yes, it plays a similar market structure role, but it still has its own asset class. It has its own underlying. And when we are looking at the underlying contracts, the expirations are different, the contract sizes are different. So I would just be very cautious of thinking them to be completely the same.
Yeah. And on that same point, Gabe, I remember when the index BVXS was first launched, was incepted, we had some discussions, conversations about the difference, the kind of like historic difference between Bitcoin volatility, the profile of observed volatility in Bitcoin relative to other risk assets, primarily, I guess, equities, and of course, as represented by the VIX. How does that play into how we should be looking at BVXS, Gabe?
So, for me, it's just the fact that Bitcoin has a lot of utility through its volatility. It's kind of like some folks tend to look at Bitcoin's volatility as a bug, and some more sophisticated investors, trader types, look at Bitcoin's volatility as a feature. Jeff Park he used to work at Bitwise, and then he went and worked at a Bitcoin DAT for some time. Really understands these implied volatility dynamics quite well, and understands how if you're savvy, you can really use this to your advantage. And so I would just say, with like what you were asking Jin a minute ago, every major asset class has had their moment where its volatility becomes more of a tradable, separate asset itself. So with equities, that's the similarity with the VIX in 2004. Rates have what's called a move index, and currencies have the CVIX. So each of these launches, you start to see kind of like this structural broadening with institutional participation in each underlying asset. And I think the BVX futures is just kind of like another watershed moment in that same category for Bitcoin. I think from a practitioner standpoint, we're going to start to see a lot of options desks that run gamma books on Bitcoin. We'll be able to hedge their Vega exposure very cleanly with the BVX futures rather than having to do any sort of proxies or set these options positions up themselves. So it's just a much cleaner way of doing so. And then you're also going to see a lot of these macro funds that run cross-asset vol books now have another tool in their toolkit to accompany the same kind of directional moves that they pair with VIX moves or interest rate moves with Bitcoin volatility moves as another leg. And so it's going to be, I think, a very significant structural unlock. And pretty excited for it.
Yeah, and I remember another thing that you mentioned quite a while ago. Actually, this was more linked with IBIT, which of course is the largest spot Bitcoin ETF in the world by assets under management, which also, of course, is NAVed, if you like, to use an ugly word, to SEF Benchmarks Index, BRRNY. The advent of options on IBIT, so more volatility, more Bitcoin-related volatility. You seem to be stating, if I'm remembering correctly, Gabe, that your observation was that the bringing this facility into the market, allowing practitioners, participants to actually have a direct and clean way to express volatility, all sorts of volatility strategies, was having a potentially smoothing effect on volatility. That is reducing volatility. First of all, fact check me if I'm getting that wrong. Inevitably, I must be getting it slightly wrong. But also, how do you think maybe the advent of Bitcoin futures based on our BVXS will impact the volatility of the market, if at all?
So I think it's tough to single out any particular moment in Bitcoin's history as being, the significant driver of compressing volatility, because of the fact that Bitcoin volatility has only kind of trended lower since its existence. And that's kind of, I think, a textbook example of what an asset does once it, grows in market cap and starts to trade on more and more venues with more and more participants, including more institutional adoption. So that's a bit kind of like, okay, I'm not comfortable, pointing out any single moment, but I would say we probably are comfortable pointing to the decision to allow these spot ETF issuers to have options markets in the fall of 2024, in a sense that the way that it impacted the vol surface of implied volatility for Bitcoin. Before I would say the unlock of spot ETF options, we always observed inherent bias for upside participation on Bitcoin's implied volatility surface, which included basically paying up for call options. If you think about the vol surface, it's kind of like it can have like these two tails. It may look like a half pipe sometimes. If you know like a half pipe is in skateboarding or stump biking or something like that, it's got these slopes. And the demand for implied volatility on each slope on each side represents the demand for downside or upside participation. And ever since these spot ETFs have these options unlocked, you would see that the call side has been continuously compressed, and that's really due to a lot of the successful, I'd say, appetite for covered call writing on Bitcoin. So harvesting, Bitcoin implied volatility to create basically like a coupon and create a return stream of income. This is something, again, like we were talking about utility of Bitcoin as an asset. It's got tremendous utility in the sense that you can write its implied volatility against it, and you can sell a covered call against it and generate, higher yields that we've typically observed around 30 to 40% annualized in some of these covered call writing strategies. And that I think really had a material impact in the shape of the curve, and you could argue that it probably accelerated the inevitable compression of realized volatility in the Bitcoin market. But that realized volatility has been in a structural downtrend since its existence.
Yeah, brilliant. And I do want to get Tomas eventually to come in on this more about the market economic aspects of this forthcoming contract. But Gina, before we do that, is there anything else that we haven't touched on? I haven't asked you that there's any potential additional elements you would like to mention about this new upcoming contract?
Yeah, I just like to say that I agree that, I don't think the volatility futures itself is going to, be bullish for Bitcoin or going to affect the price direction of the Bitcoin, because it's purely a direction neutral product. And structurally, it's just, constructive because it's a better hedging tool, and it will support deeper participation from institutions, from retails. And I think the more broader market impact we will observe is that Bitcoin is going to become more mature, and that's already observable from the CME market, or when we see, there's like larger volumes of basis trading of all kinds of like more advanced strategies. So the launch of this volatility futures is just going to, enhance that and increase the liquidity across the market, especially the regulated ones.
Absolutely. And I think, it's axiomatic, but of course, it's not a bad thing to underline the fact that, of course, the BVXS, which is the settlement index for the new contract, is based on, exclusively CME Bitcoin options trading, right? So therefore, it has already a structural element of cleanliness, if you like, for want of a better word, as related to the type of Bitcoin options trading and volatility that goes along with that market, correct?
Yes.
Okay, perfect. And Thomas, from your view about market economics related to crypto, what is your essential takeaway as regards this completely brand new tool? For the first time, you'll be able to trade Bitcoin volatility in a pure sense, based on CME Bitcoin options, which is, it's got to be something of a bit of a holy grail related to Bitcoin coming right now. So, I mean, clearly both Jin and Gabe are correct to caution that we shouldn't expect necessarily any major sea changes due to the launch of one contract. But clearly it's a bit of an epochal moment, a bit of a watershed. So what do you think it unlocks in your view?
So I agree with Gabe quite a bit on this like structural decline in volatility, and it's like pretty straightforward. Like if you believe Bitcoin is going to be an asset that crosses like $10 trillion of market cap one day, like you can't really have a $10 trillion asset with 50%, 70% realized vol. It's kind of nonsensical. So as you get more maturity, more value accrual, etc., naturally the volatility starts to come down because it's a representation of the asset being held in more diverse hands for more diverse reasons, and so that creates less kind of structural volatility in general. I've been really interested in volatility products for a long time. Fun fact, but there's a Twitter account called BVXS where we did this volatility index methodology against deribit options back in like 2018, 2019. It doesn't work anymore, but we were actually calculating it back then because I wanted to have a measure on the market's expectation of forward volatility. And so I think it's going to be a really interesting product because Bitcoin is still going through, what I think is going to be like a very large adoption shift near term or acceleration, similar to how you see broader technologies get adopted. It follows an S curve. And I think we're kind of in the early innings of this like acceleration phase for crypto in general. And that's a moment where volatility and volatility products really shine. So I'm really excited about it. And I agree. I think anytime you can kind of compartmentalize risk, it provides for creative or interesting opportunities where people can more efficiently structure their portfolio and exposure.
Perfect. We are winding up quite elegantly to time, ladies and gentlemen. I want to get Mark in to begin our closing segment, talking about what's on your radar for the coming short-term week, if you like. What are you looking at, Mark?
Yeah, for the week ahead, I'm going to be kind of keeping a pretty close eye on where the market structure bill goes, the Clarity Act. Let's see if we can get to a floor vote here by the end of the month is essentially what I'm watching for.
Yeah. And maybe Gabe, anything macro-wise that you're looking at that could have a big impact? Not sure what the calendar is looking like for the next week.
Yeah, I think obviously clarity is a huge topic, particularly for our industry. So keep an eye on that. I think also on the 22nd this month, we're going to get the FOMC meeting minutes for April. And I'm just kind of curious to see what statement changes kind of like happened and kind of what were the more detailed, discussions around these dissents were. It is a little bit lagging in a sense that we've had more data that we kind of know puts them on a directional path to be more hawkish, but I still think that's important to kind of get more of a deeper, detailed insight into the committee and what they're thinking currently. So I definitely would bookmark that.
Yeah, and Thomas, I know that we've already mentioned a lot of this stuff, and there's a little bit of a sense that we've had the major data of the month, but we've still got a few things on the calendar. I want to ask you about that first, but then I want to ask you about market structural seasonal factors that may be coming in as we head into the summer, essentially.
Yeah, I think my personal point of view, the next few weeks, what really matters is going to be Clarity Act vote today and possibly tomorrow if it extends or delays. what you really want to be on the lookout for is whether the final vote for passing the markup through committee, whether it's bipartisan or party line. If it's going to get through either way, I believe, but if it's bipartisan, I think that's a reason to get even more bullish. You also have the Trump-Xi summit that's happening right
Yes.
now, which is very meaningful and possibly an influencing factor in what's happening with Iran, where really over the next couple of weeks, you're going to have, I think, substantial movement just on the premise that the ability for Iran to continue to store oil production is really coming to a head right now, where this blockade has prevented them from exporting oil. And if their storage facilities are backed up, it's not a situation where you can just flip an on-off switch when it comes to oil wells. If you shut down the production, you can actually impair the asset permanently. And so I think we're getting to a geopolitical head, and this meeting with China is going to be, I think, really important and possibly a point of leverage for coming to terms on a broader China deal, but also something to do with Iran itself. And that'll be very meaningful for the market in general. As far as seasonality with the summertime, I don't know.
Yeah.
I think this summer is a bit different because you have so much geopolitical stuff going on, and with inflation being hot and monetary policy like going left and right, I think it's going to be an active time. I don't really think that there's a reason to believe it's going to slow down just because it's May or June.
Absolutely, absolutely. And June, I do want to ask if there's anything else that you wanted to add before we round off here at all.
No, just a really excited time to observe, and we are really excited for the launch and see how the flows are gonna be.
Brilliant, brilliant. And that, of course, is Jin Wang, our Senior Product Manager from CF Benchmarks. We've also been joined, of course, by Thomas Perfumo, who's Kraken's Chief Economist, Gabe Selby, Head of Research CF Benchmarks, Mark Pilipczuk, our Research Analyst, and myself, Ken O'Delaga, Head of Content. Thanks a lot for joining us for this latest CF Benchmarks space. Join us again in about a week for the next one. Speak to you soon. Thanks, everyone. Cheers.
Thanks, yeah.
Thank you.
All right, thank you.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. This recording is not intended to persuade or incite you to buy or sell any financial products noted within, including but not limited to exchange-traded funds, mutual funds, equities, other instruments that reference any index provided by CF Benchmarks Limited, or crypto assets. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making an investment decision. Note, some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.